Good day, everyone, and thank you for joining us on Tata Chemicals Q1 FY19 earnings call. We have with us today Mr. R. Mukundan, Managing Director, and Mr. John Mulal, the Chief Financial Officer. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available in the results presentation. I now request Mr. R. Mukundan to begin proceedings of the call.
Thank you, Gavin, and thanks everyone for joining our earnings call. Today I have with me my colleague, John Mulal, our CFO, who will run through the headline numbers and briefly update you on our financial position for the period under review. Prior to him doing so, I'll just give a broad highlights of the business and the strategy and also the quarter gone by. This quarter, we completed the transfer of our phosphatic fertilizer business, which includes the facility at Haldia and trading business to IRC Agrochemicals, which is part of the Indorama Group. With this, our exit from fertilizers is complete, and the major step in our stated strategy, that is to focus on leadership position in the basic chemicals while continuing and investing to grow our consumer and specialty products, is well underway. Post the divestment of fertilizer business, based on the recommendations of audit committee, the board has approved a new segment reporting, which brings far more clarity to the way we run the business. And the three segments are the basic chemistry products, which includes the soda ash, bicarb, and other basic chemicals, which has long formed the backbone of the company. The second segment is consumer products, which includes salt, pulses, spices, and branded consumer products, which is the growth business of the company, which already has a substantial revenue and profit momentum behind it, and has been sequentially growing over the past few years in a very on the back of the strong consumer market growth in India. The third segment is specialty products, which includes the agrochemicals business and the seeds business in Rallis and Metahelix. Coupled with the new investments we are making in nutrition solutions and advanced materials, these are products which have come out of our innovation and R&D center in Pune. This R&D and Innovation Center in Pune also houses our food science lab, which is where most of the new products which enter the consumer product portfolio are being designed and developed. So this segment reflects the current strategy and the structure of the company, and also clearly defines the growth drivers for the company, which are mainly in the consumer and specialty products. On the quarterly performance, the basic chemistry products, which is soda ash and bicarb, continue to deliver steady performance, and the overall situation in the marketplace remains fairly tight. We had highlighted during the previous call, we need to wait and watch for the situation as it unfolds when the Turkish capacity comes on stream. And in reality, the full Turkish capacity is now come on stream, and the market still is tight on the back of very strong global demand for soda ash, and we anticipate that this trend is likely to continue. On the back of such a strong demand pattern and the tightness in supply situation, the energy cost increase which this business had to incur has been fairly passed on in a manner that we've been able to hold our margins in this business at a steady pace. While operating performance in India was on par, the U.S. operation, we had a planned shutdown in this quarter, which was part of the overall plan to hook up equipments related to improving the environment performance, which was part of a long-term plan, and that has been hooked up, and the plant in U.S. is back to full production as we speak. Kenya had a minor hiccup in terms of heavy rains, which caused a bit of operational difficulties, but the plant has fully recovered post that operational difficulties in Q2. These led to some minor negatives in terms of the operating performance, but that was more or less made up by excellent performance coming in from India and UK. Overall, the market remains tight, and our trend remains to be that if this global situation continues, it is going to trend towards even greater tightness going forward, and we remain extremely positive on the margin protection in this business. This business, as you know, is our cash business, so we are focused on this business in generating cash for our growth, and the growth businesses are the consumer products. On the consumer business side, Tata Salt continues to deliver volume and value, and we have launched a slew of products, but the three platforms which we have spent time maximum on, which is salt, pulses, and spices, are beginning to trend in a very positive direction. The mature part of the business, salt, has trended positively. In terms of the consumer metrics, the businesses, both pulses and spices, have trended very positively, delivering on a base which was low, over 100% growth, year-on-year growth in terms of the volume numbers. We do believe that this business overall has delivered about 33% growth in terms of revenue, and it would continue to sort of trend in a strong way moving forward. During the quarter, we also launched a new set of products, which is chutneys, and also we have launched several other new variants in the marketplace, which were available on Amazon and other modern trade stores. Our approach to seeding the business is primarily to launch them in e-commerce platform, moving them onto modern trade before bringing them to general trade, and that trend has continued, and it allows us to sort of pick the winners out of the product when we launch and then move the winners into general trade over a period of time. And you would continue to see every quarter new product launches and the older products maturing and grabbing market share and moving forward. In terms of specialty products front, Rallis and Metallics showed healthy performance. This segment grew 25% year-on-year. Our plans for nutrition solution and SGS facilities on schedule. We already announced during the quarter the acquisition of Allied Silica at 123 crores, where additional investments are being made to get that plant up to speed to Tata standards before we start supplying to the customers, both in food and in the rubber space. To conclude, we remain committed to our strategy in transforming this business, moving beyond the leadership in chemicals business to gain and garner our position in consumer business and also to get leadership in specialty business. So effectively, we are on our way to moving forward, and I'm confident of meeting our strategic objectives. I now would like to invite John to give his insights on financial performance.
Thanks, Mukund. I'd just like to echo what Mukund said. You know, if you read our integrated report we issued before the AGM, I mean, the title page is Transform to Grow. As we've done a good job of, in the last 2 years of transforming the business. We exited the final piece of the fertilizer business on June the 1st. And in light of that, the board recommended that we did also transform how we report our business segments, aligning what we want to do strategically in the next few years and focusing on consumer products and specialty products. These quarter results are the first results where we've shown the salt operations as part of consumer products. Naturally, you will see it's manufactured within the chemistry business and it's sold through a consumer business, and we use a transfer price, a proper calculated transfer price to appropriately share the benefits of both operations. Specifically for the quarter, our revenues were both up on a consolidated basis by 10% on 242 crores and on a standalone basis by 15%. This mainly represents increased sales of salt over last year by about 42,000 tons and also additional revenues from our pulse business. Our consolidated profit after tax, both from continued operations and also including the discontinued operations, are both up by 24% and 16% respectively, and our standalone profit from continued operations was up 70% at 190 crores. Our consolidated cash at the end of the quarter was 4,960 crores, of which 3,996 related to TCL standalone. On a standalone basis, the company is net debt free with net cash of 2,855 crores, up from 2,347 crores in March. But bear in mind, we have the dividend payment and DDT payments to come off that. So further 670 crores relates to that. That will come out in July and August. And finally, our subsidy outstanding at the end of June was 511 crores. That's down from 859 crores in March and 1,105 crores in June 2017. On the back of that, we'll open up the lines to any questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tarun Lakotia from Kotak Securities. Please go ahead.
Hi, thanks for taking my question. First, I'd like to appreciate the adoption of new segment disclosures, which will help us relate with your strategic focus on consumer and specialty products in a better way going forward. Could you just help us understand the inter-segment transfer between, say, basic chemistry to salt business? Essentially, what I'm trying to understand is there a portion of margins related to salt, which is in manufacturing part itself, included in basic chemical segment?
Yes, that's correct.
Yes, I think the manufacturing margins are in the basic chemistry products, whereas the beyond manufacturing, the margins are all loaded in the consumer product, which was the right transfer pricing tool we have adopted.
Is there any color that you can give in terms of what is the proportion which is being retained in the manufacturing side?
No, I think broadly speaking, the color which you would see is that the margin structures in consumer products would reflect the margin structures which exist in most consumer products. We've actually chosen margins which normal consumer companies earn, and these are independently reviewed by auditors and two independent valuers to arrive at what is the appropriate and market acceptable, and this is also done in a way that tax authorities will also have resonance. So it reflects what is expected in a consumer business in a normal range.
Fair enough. Could you just remind us, the amount of loss which you would have made on the X of salt business in consumer product for fiscal year of 2018? I mean, but I'm talking about that 100 odd crores of revenue which you got from pulses, spices, and other products last year.
No, not really. I think there's marginally, it depends on what kind of costing you want to adopt, but I think there are several shared resources. If you look at the teams which run and all, I think overall this new structure, effectively, I think most of the products are at the gross margin level. They're certainly positive. Even at the post the appropriate fixed cost absorption, they should all be positive.
Mr. Lakotia, may I request you to join back the question queue for any follow-ups, as we have several participants waiting for their turn.
Sure.
Thank you. We have the next question from the line of Amar Maurya from Emkay Global. Please go ahead.
Yes, thanks a lot for the opportunity. So firstly, this US plant and the Kenya plant, for how many days these two plants were for the shutdown?
No, really, I think if you say what is the lost tonnages we had in Kenya, we had lost ton of about 16,000 tons broadly, and in US we had something like 25,000 tons.
Okay.
And just a point to make, in the US, it was one production line down for a scheduled extended maintenance period.
Okay. And secondly, sir, now on a consumer business.
Yeah, just to add also on Kenya, the plant was not stopped ever. Plant was running, but at a lower load because of logistic issues of shipping through, flooded roads and flooded rail lines. It was more an issue. We had to slow down our rate of evacuation.
Okay, sir, that's helpful. Secondly, sir, if I look even the India business, the volumes were down on a year-over-year basis. So is there anything to read into this? I believe the realizations were pretty strong. So over.
I think one of the points which we are doing even in the Indian business is to slowly move the soda ash, which is marginally down, also to shore up the volumes up in terms of the bicarbonate, which is marginally up. And these will be minor issues of sales and evacuation and dispatches. There's nothing to speak home about in terms of production.
Okay, got it. And secondly, sir, if I can ask, on a consumer business, as you had said that the series of new launches are going to happen. Like this year, I believe we launched Chutney. So basically, sir, I mean the 5,000 crore rupees, the run rate which we are talking about as a vision for the overall consumer business. I mean, how much of this is going to be driven from the organic growth and the new product expansion? Any clarity, or because I mean, beyond the point, we will not be able to feed the new product launches, because when we launch new products, there is a expenditure at all angles, right from distribution to the marketing and at every level.
Yeah, so I think if you look at it, broadly the 5,000 odd crore turnover is built largely on three platforms, which we already have presence in, which is salt, pulses, and spices. In the salt, you would see year-on-year investments of approximately, let me say that about 100,000 tons of additional salt being brought to market to feed what we call as our opportunity markets. These are markets where our market share is still not in line with our national average, and so there are still opportunities to grow in several parts of India where the distribution is being strengthened. So salt, the strategy is to improve the reach. So in about 4 years' time, we should be reaching a figure of from approximately 1 million ton of salt to about 1.4 million ton of salt, for which the board has already approved close to 500 crores of investment, which is being invested as we speak. So this is part of the growth agenda, which should account for at least 50% or more than 50% of the turnover at that point, or when we said it will be 5,000 odd crores. The food, which is the non-salt food categories, two categories account for the balance 50%, where again we are investing and co-investing in various packing centers and distribution center along with our partners. This may not fully be reflected in our balance sheet because there are enough partners who are willing to invest for us. And this is going to be a slew of products which are built on what we call as various platforms. The first platform is the protein platform, and the vegetable protein platform has pulses. It now has organic pulses, which was launched this quarter. It has first powder which we launched was besan. But then on top of that, we have launched mixes. The first mix which we launched was Khichdi mix. Then we have launched Nutri mixes, which are Chilla mix. Very shortly, we will also launch other mixes where pulses are added. To give you a slight color on that, it will be things like, dokla, idli, dosa, all of these, where some element of pulse exists. They are all going to be part of the protein platform. And these are all products which are designed in our innovation center. And the common characteristic of them is that they rely heavily on one form of dal or another form of dal as the ingredient. When it comes to spices, there's a second platform which is part of our completion of taste portfolio. In taste portfolio, we first launched the CTC, which is chili, turmeric, and coriander in form of straights. Then with various mixes, we currently have a range of about 6 mix. And we are not present all India because we have stayed very much focused on north, west, and east, and we have stayed away from south in terms of penetrating spices because the spice mixes in South India tend to be very different in terms of range than rest of the country. So our first focus is to deliver on these 3 regions before we go to south. We've actually taken a strategic wait for the southern market, but we will enter at some point. So our broad numbers on this 5,000 odd crores is colored out of these 3 ranges, 3 categories and 3 platforms. Any additional platform we launch will only add to this number.
Thank you. The next question is on the line of Abhijit Akela from India Infoline. Please go ahead.
Yeah, good afternoon, gentlemen. Thanks a lot for taking my questions. Just a few questions aimed at understanding the segment disclosure a little bit better. On the last conference call, I believe we had said that total consumer revenues for the company stand at about 2,000 crores, out of which salt alone would be 1,700 to 1,800 crores. When we look at the new segment disclosure, it shows a number of around 1,500. So I was just hoping to understand why that difference there.
No, I don't remember saying 2,000 crores, Abhijit. I think we said about 1,100 last year. I think the results are about that number.
Oh, okay. All right, fine. Maybe I can check back with you offline.
Just check. I think our figure was we should be clocking around 2,000 the current year. I think that exit rate was about 2,000.
Okay. And out of which salt would be about 1,500 or so. That the right number?
I would say it maybe even more, maybe about 17 or so, yeah. 17, 18, yeah.
Okay, understand. And the inter-segment revenue that's shown there of 695 crores for the full year, March 18, that basically, does that primarily represent the sales of salt from the basic chemistry segment to the consumer product segment?
Right, that's right. Absolutely correct.
Okay, understand. And the jump in consumer products EBIT that we see this quarter compared to both the previous quarter as well as the corresponding quarter last year, it's up from the 50 crore odd range to 82 crores this quarter. Is that driven primarily by margin improvement in the non-salt product segment?
It's primarily driven by, the fixed costs are fixed for us. They are not increasing substantially. So when that 100 crore of additional revenue was throughput this quarter, a lot of it actually translated to bottom line. That's what you're seeing there.
Okay, so it's premature to conclude that the non-salt portfolio has turned profitable for the quarter?
No, I'm saying that the non-salt portfolio is delivering margins, and it's showing a disproportionate number, because if you say on 100 crore additional revenue, we've got 30 crore bottom line broadly, or maybe 26 crore 30 crore bottom line, and that is because the fixed costs are fixed. The entire gross margin is flowing down.
Yeah. Sure. So this is a sustainable number going forward then?
But the fact is that there could be some quarters where there could be discretionary movement of 5 to 6 crores or 7 crores, which depends on advertising spends. That's the only number which I don't want to guide on, because that I leave it to the teams to deliver, because that's pretty critical. That's like an air cover. They launch an aircraft when they need air cover. That's it. So other than advertising discretionary spend, I don't think any major moves will be there. But I can't very pinpointedly tell you that this is the number, because quarter on quarter they may have different plans, because sometimes Diwali will come in second quarter, sometimes it may come in third quarter, and they need to launch a blitz, they will launch a blitz at that time.
Sure, understood, sir. Appreciate that. And the 500 crores worth of capex that you mentioned for salt over the next 4 years, that we should assume that comes up within the basic chemistry segment, right?
Yes, that's right. I think it's part of the 500 to 550 odd capex which we regularly put in, so it is already part of that range. This year, I think our capex may be trending close to 800 crores, about 500 in the basic chemistry, and about 300 odd crores would be spent in the specialty product segment. Part of which I think Rallis may end up with something like 25-30 odd crores, and you would have a capex of the balance number would be in Nellore plant, which is for the nutraceutical, and the other part will be in the Cuddalore plant for the HDS.
Thank you, Mr. Akela. May I request you to join the question queue for any follow-ups? Thank you. The next question is from the line of Arjun Ashar from Envision Capital. Please go ahead.
My question was, this consumer business of the company, will it stay with the company going forward? Because there is talk in media about it being merged up with some another Tata Group entity.
So I think these are speculative news, and there is no active proposal either with the management or with the board. We also read the same press, so we have the same news.
Okay. And recently I saw your advertisement for Tata Sampann on some very mainstream popular shows on general entertainment channels. So should it be read as a sign that you have hit some kind of critical mass in your distribution or anything like that?
Yeah, I think we have a critical mass. At this stage, I would say some amount of ad spend may be the air cover, which is beyond what our distribution ought to be. So clearly, if you look at our reach in terms of direct reach, I'm not going to speak about indirect reach, that is fairly wide. It is approximately 0.6, and I think our number is to sort of reach about 0.9. I think that's really where we are headed to.
Okay, and do you have some kind of a big campaign coming up in future in advertising on these mainstream platforms, or it will be in bits and spurts as it is right now? The ad campaign?
I think there's a media team which has very good understanding of what to do, so I leave it to them. I really don't have a specific plan which I would like to share at this point of time, but clearly they understand what product needs what kind of a support. If it's an initial launch phase, they spend mostly on trial inducement. After the trials are induced, if repeats are very good, then they launch a plan for what we call as supporting at the point of purchase, so that there is adequate active support. And finally, once that reaches maturity, they would go mainstream media. So it's clearly a three-phase approach, and it is something which the team is well versed in sort of delivering this.
Okay, and the final question, the impact of fall in the Turkish currency on global soda ash prices and the anti-dumping duty which has been taken off in India?
So, as I mentioned, I think there's been hardly any impact of any. This is what I've been saying even in the last call. Anti-dumping duty may not play out as a big an event as we thought, and it has not played out. The market is extremely tight, and prices are going to move up in rupee terms in any case, because I think those customers who relied on imports are really going to be paying because rupee also is weaker. So I think the market has a natural hedge through the rupee dollar movement, and
the Turkish currency.
Turkish currency has no impact because this is a trade which is done in dollar terms.
Okay. Okay, so you don't foresee any kind of volume ramp-ups on their part because they would be desperate to earn those dollars or anything like that?
These ramp-ups cannot come that fast. I mean, if you think of a ramp-up today, then I think it takes about 3 to 4 years to hit the market.
Oh, okay. Thanks a lot.
Thank you. The next question is from the line of Viraj Kacharya from Securities Investments. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just had a couple of questions. First, on the soda ash part. So you talked about us having a potential loss of around 25,000 tons in the US. But even if you adjust for that, you have seen some volume degrowth in Q1. So I'm just trying to understand, if you look at full year for FY19, should we see some positive volume growth in US and other geographies for soda ash?
The annual numbers would be almost flat, so I don't see any change in the US number because they're running flat out. So our annual numbers still remain the same, so there is no impact on that. In UK, for example, there will be a volume fall if you just look at the volume, but that is mainly the quantity which we have pulled back, which was a traded quantity, which means we were not manufacturing it, we were buying from a third party and selling it to a customer. We pulled back from that because it was at zero margin, so there's no point chasing volumes which are at zero margin, so we took a call to move away from that trade. As far as Kenya is concerned, I think this 18,000 ton loss is a one-time loss. It probably may not get recovered, but for the year, they should deliver better performance than what they did in first quarter.
Okay. Second question was again on soda ash. So if you look at next 2 years, you highlighted the market itself being very tight and the demand is very strong. So based on our current utilization levels, would that be enough to meet the market demand, or would we need to have see more investments in soda ash to meet the incremental demand?
So in terms of our investment strategy is that we want to be very measured in our capital investments, which are focused on consumer and specialty product. And consumer, of course, doesn't need that much of a capital, but our focus is to grow these segments. On soda ash, our view is to do debottlenecking in US, where I think the plan is already underway. Those capacities may come on stream, but it's not a big part of our growth agenda. In India, certainly we have also put in put in a debottlenecking plan, which is subject to government approval. So in India, I'm not willing to commit when it will come through, but I think it's largely subject to various approvals which we need for this kind of a unit. As far as UK is concerned, there will be investments in UK, but they will be more focused on value moves, which means within the product range which we have, they may move to higher value product like bicarbonate and other products, but they're not going to be spending to increase the capacity. So you would see a value shift in UK, you would see slight volume growth in US, and some volume growth in India. That's about what we are thinking of, and this spread over about 3 years. Our capex numbers are close to about $50 million in US and about 1,500 crores in India. So that's broadly the number. Of that you need to knock off 500 crores, which has been earmarked for salt, so about 1,000 odd crores for soda ash. But this is spread over 3 to 4 years, so it's not a big number for us.
Okay, just one last query was on the consumer business, the food business. So in last 1.5 to 2 years, we've launched a lot of new products, in the market. So, in how many of those products we would have seen those products eventually evolving to, say, modern trade or a general trade? Just trying to get a sense in terms of how we are.
So I think if you monitor the online stores, e-commerce, which you can very quickly go, you would find the product range there. That's the product range which is stabilizing in the market. So clearly, you would see the pulses, the mixes, as well as the range of spices available in that, and that's the same which is available in the modern trade too.
Okay, just last query was on the tax rate. So this quarter the tax rate has been quite high, around 35%. So, how should we look at it on a sustainable basis?
Standalone basis is about 20.5%.
Yeah, on a console basis, I meant.
You can't look at tax on a console basis, because the various impacts of losses in one country or against profits and all that. We don't plan that way either.
Okay, thank you.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi sir. So my question is regarding UK business.
Mr. Kumar, can you use a handset, please? Audio.
Hello?
Yeah.
Now it is okay?
Yeah, please go ahead.
Yeah. So my question is regarding UK business. So we have seen an incremental 18 crore sales in Q1 FY19, while we have seen an incremental EBITDA of 23 crore. So can you tell me what is the key reason for that, and what is the sales mix?
Last year. The fire. Yeah, last year the Lostock facility suffered a fire, and it was down. Actually, there was 2 incidents last year, which constrained production. And this year, what you've seen is fairly decent production. I think it was only one upset through the quarter, as well as we also received some insurance payment of about £1.5 million related to the fire last year.
This year production is a normal. This year run rate is a normal run rate. Last year there was some disturbances in the plant. That's the real issue. So I think this year number is the real number.
Okay, and could you please give us the breakup of UK business? How much salt, power, and all?
No, we don't. We haven't.
So the power operation is directly linked to the soda ash operation, so we treat that as one sector. So we don't think of it separately. What I'd say is probably the soda ash bicarbonate unit represents probably 75% of the total.
Okay. And rest salt and power.
No. Power is part of the soda ash business.
Yeah.
Okay, so we can say 25% salt.
That's fair, yeah. Yeah, but in terms of margin, I think at EBITDA level it will be the other way around, which is 1/3 would be so the soda ash and power business, and 2/3 would be salt.
Margin side, okay. So can we assume there is the higher sales of salt this quarter, so margin expansion?
In UK, I think it is mostly B2B sales. We sell to brands, and UK salt demand is pretty flat because it's a very, very mature market.
Okay.
But you should think of the UK salt and UK soda ash and UK power business are part of the basic chemicals product, because we don't think of that as a consumer business at all. and they are reflected in that segment. So don't split the UK salt into the consumer. Consumer product is effectively consumer product in India.
Right. So you said there is you shut down the plant because the margin was thinner?
No, sorry. The UK also used to supply to, till last year they were supplying what was known as product meant for trade, which is about 23,000 tons, which was material bought from other manufacturers and supplied to customers in UK, which they have stopped. The traded volumes were stopped, not the manufactured volumes.
Sure, Mr. Kumar, may I request you to join the question queue for any follow-ups, as there are several participants waiting for their turn.
Okay, thank you so much.
Thank you. We have the next question from the line of Rakesh Vyas from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good afternoon. My first question relates to the salt business. So if I look at quarter-on-quarter sequentially, the revenues and the volume seems to be almost similar, but the profitability in consumer product has improved significantly. So is it fair to assume that large part of this is led by improvement in the margins in the salt business, or is there any one-off?
It's
in either quarters.
No, it's improvements both in the margin and all the three categories: spice, pulses, and salt.
Why I'm asking this is, sir, because the inter-segment increase in revenue is almost 15 crore. The total increase in revenue sequentially in the consumer product is 30 crore. The volumes in salt business are almost same. So I'm just trying to, if there was a transfer pricing on manufacturing, it's all passed in.
It's what Mukund said earlier about with very low volumes last year on pulses and spices.
No, he's talking sequentially. So I think sequentially also the fact is that the margins in all three categories have improved, and it's margin improvement. You're right.
Okay. Clarity of the salt business, sir, the annual report suggests last year revenue to be 1275 crore, FY18. And you seems to be indicating that this year revenue could be 1700 crore. I didn't got that bridge correctly, it seems.
Yeah, the way the 2,000 crores or 1,700 crores came from, that was the exit rate from last year.
Yeah.
It wasn't the run rate this quarter. We should be above last year because our performance has improved in the first quarter. But that's as far as we're saying.
So we should expect this 1275 to improve materially, but it will not be 1,700 crore for FY19.
Yeah. As the additional capacity comes on stream that Mukund talked about earlier, we'll increase the revenues through the salt business. Yes, that's right.
My second question relates to India soda ash business. So we are expecting Rohit to commission their capacity sometime soon. Given the tightness in the market, should one expect any major impact on pricing, margins, etc. in near term over next 4 quarters?
Sorry, can you repeat that? What did you say?
So Rohit is expected to commission their capacity sometime soon. Given the tightness in the overall global market, should we expect any impact of pricing or margin in India because of the ramp-up of the new capacity over next 4 quarters?
No, not really. I think, we adjust the prices as the dollar rate changes. I think if you look at it, even as recently as I think the current week, there has been a move of about 500 rupees in pricing. Prices have increased by 500 rupees because the rupee has fallen. So I think this will be just benchmark to the rupee fall. And we don't see any material impact of the supplies coming on stream because, in fact, the market will be fairly tight, even post that.
Okay, great. Thank you so much. I'll get back in queue.
Thank you. The next question is from the line of Madhav Martha, Fidelity. Please go ahead.
So just wanted to understand on the consumer business, I mean, all the products that we are launching, just in my understanding, they seem like products which are, I mean, extremely unorganized, that people are buying from the normal retail shops, and we are trying to brand them and package them under our very strong brand name. But I'm just trying to think, how should we get confidence on that scaling up and becoming profitable, because there'll be so much competition from the unorganized side, or it's something that we've done in salt over the years and we're trying to play the same card here?
So I think the fundamental way is that if you go to the shop and see the pricing, I think you'll see the pricing is at a premium, and the customers pay a premium for quality. Customers pay a premium for assurance of purity. So I think it's about the switch in the marketplace, which is move from unorganized to organized, from unbranded to branded. I think this is going to play out, and the Indian market is not going to be any different. The only thing is that the consumption pattern in India for food is very specific to Indian food habits. So that's the difference which we will see in the kind of products being there in the marketplace. So our view of this entire market is that this market is going to increasingly get organized. And broadly, I think overall about 8 of the metros will account for maybe 50-60% depending on the category of the demand. And the rest of the country will be the 40% demand pattern. So this is going to be led by the fact that this will be driven by the urbanized parts of India and will filter down over a period of time into, let's say, semi-urban and rural parts. So it's a process, and it's a process which has happened in various categories where players have entered. Where players have not entered, those markets have not organized themselves. So it is just the way on salt we entered, and some people entered atta, some people entered rice. Those got organized. So I think we are only working on the process of getting these segments organized and moving them to branded space.
Good. So just a second question on the spices side. If I just did some basic research on Amazon, etc., so there are some of these players which are already in the space. I think there's MDH and there's Archie, I think, in the south. So there are these decent brands that have been established over the years. So is there any differentiation that we have above them, or how do we intend to compete with these players in the spices category?
So we've got 3 categories, which is healthy for you, good for you, and fun for you category. And right now we are in our focus is on healthy for you. And even if you look at spices, our focus is to deliver spices with a higher amount of essential oils. Most of the other spices, we've moved away from that, and I think the whole issue for us is around retention of these active ingredients. So our turmeric, for example, has got a higher proportion of curcumin. So these are all scientifically done in our lab, and it is supported by claims. And secondly, if you look at our packaging, it is pack and pack, so it's a single-use pack. There are 5 packs within one big pack of a carton, and it retains the freshness over a longer period of time. So the teams have worked out what is a unique selling proposition for each one of our category, and which is why these products have found the resonance, and they would continue to garner market share and also drive the growth in the market.
Okay, right. Thank you so much.
Thank you. We have the next question from the line of Vihang Subramaniam from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. So my question is basically related to the reclassification of segments that has happened. So from my understanding, you've taken salt out of the inorganic chemicals, and that is now in consumer products. And in the last 5 years, the consumer products division, which consists of pulses, spices, and nutritional solutions, it has never been profitable on an operational level. So in 1Q FY19, you have done 82 crores of EBIT on like 438 crores of turnover. So I'm assuming that the entire thing is related to salt here. So is that assumption correct?
I think the entire move is not related to salt. It is related to all 3 categories. But salt is a big portion of it because the salt has the highest share of the revenue.
Okay, so you're saying that there's some margin improvement in pulses and spices as well, right? That you've witnessed in 1Q FY19.
That's right. And I think that as volume moves, the margin also moves. So it's a phenomenon in consumer products. As your volume picks up, the margin also picks. They both move in tandem.
Okay. Okay. So, but in the last 5 years, what has gone wrong that, you have never been able to generate, so do you think this year you're saying margins have improved? Do you think, this year probably the consumer business, excluding salt, could be profitable?
I think, firstly, last 5 years is a misnomer. Spices, this is obviously second year of operation in 3, but I think it is difficult to say that. So last year was a very small number. This year is slightly better number in terms of volume. Yeah. But if you look at pulses, last year the big setback obviously was that we had to reconfigure our entire supply chain based on the learnings from a market where there are controls in terms of movements of prices. So that supply chain has been reconfigured and has worked very well even in terms of high levels of fluctuations, delivering steady margin. So we've done that bit, which is part of the learning process. And some amount of element of destocking, some amount of slowness in the market which came through disturbances which were let's say policy-led, those have not been events this year.
So do you expect to be profitable in the consumer division this year, like these margins which you spoke about, which have improved? Do you expect them to sustain throughout the year?
So I'll repeat the same caveat. Quarter on quarter, it should deliver similar numbers, but for the advertising and discretionary spend, which will vary from quarter to quarter.
Okay. And just one more question.
Mr. Subramanian, may I request you to join the queue, sir? For any further questions?
Yeah. Sure.
Thank you. We have the next question from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, thank you for the opportunity, sir. First of all, a very, very productive presentation. Thank you for the same. Sir, firstly, sir, if you could say what are the likely margins for our foreign operations, that is US, UK, and Africa? We find them at decimal levels of 4 to 8%. Maybe one-off items if we exclude also. What is the margin trajectory from these geographies, sir? Hello?
Yeah. I think so we've given an overall number in terms of
No,
just hang in a minute. I think they're looking at no, but I think so broadly speaking, if you look at our U.S. operation, the U.S. operation is fairly profitable, and UK and Magadi, the margins are what we have guided was EBITDA of about 25 million pounds and a $10 million for Magadi, and about $100 million for US. Broadly, that's the EBITDA margins which we had guided. So that remains pretty steady. I think the impact of energy costs has been fully been factored in now, and it's translated into market price, and the margin has been more or less protected.
So I was looking at the PAT margins, sir. The PAT margins are considerably lower than what the peer comparison are. I think these are the natural producers for US. I think so. It is the natural soda ash.
So I think if you look at EBITDA margins, it is broadly between, let's say, 15 to 19 or 20%, 18 to 19 or 20% in US, and PBT margins would be closer to 8, 9 or 10%. It will be in that sort of a range. And US and UK, Kenya also would tend to be in the same range, and UK tends to be slightly different in terms of its PBT margin because it's highly, there's a heavy amount of debt in that company.
Correct, sir. And last question is, sir, again on this Turkish lira part. Sir, don't you think they would be having an edge over that currency being depreciated, and so they can also upload more stock with lower margins since the currency has depreciated vis-a-vis USD?
I really don't because this is a dollar trade. It's a really dollar-denominated trade worldwide, and the pricing is all negotiated in dollars. And everybody is sold out. There's no material. In fact, if there was a ton available, it will move to the highest price buyer.
Thank you. We have the next question from the line of Amit Murarka from Deutsche Bank. Please go ahead.
Yeah, hi. Good afternoon, everyone. I just had a question on the segmentals again. So if I sum up the three segments, which is basic consumer specialty, and the number that I get, there's a difference of about 675 odd million rupees between the console EBIT and this. So it seems like there was an exceptional gain of 64.34 crores in TCNA. So is that like booked in the basic chemistry division here?
No, there's no exceptional gain in US.
No, in FY18. This is part of your notes.
FY18. Yeah, FY18 there was a gain.
There were two things happened in the US last year. One was the change in federal tax legislation. And also there was a issue where we changed the post-retirement medical benefits. Okay. They were all both disclosed in the December 16 results.
Yeah, so what I'm asking is also, yeah, so the EBIT that is there for basic chemistry division, does that include this 64.3 crores of one-off exceptional gain? It seems to me like that, I mean, based on the...
Yeah, it will do, yeah, absolutely.
Yeah, oh, okay, that was, yeah, that's all, yeah.
Thank you. The next question is from the line of Rakesh Vyas from HDFC Mutual Fund. Please go ahead.
Yeah, thanks for the follow-up, sir. On the pulses and spices business, if you can just throw some light on how the ramp-up has been quarter on quarter, because as you highlighted, last year, first quarter was probably a low base. So just trying to get some sense on how the revenue has been moving sequentially here.
Sequential. No, he wants sequential. Yeah, sequentially it is a growth of approximately 20-odd% in pulses, and in spices it is, I don't know whether percentages matter in spices because it's 250% sequentially. So I don't know what you want to make out of that.
If you could just give the consolidated revenue of these two in 1Q19 and 18, that would help. Just to get a sense how it's ramping up.
No, we have the sequential quarter number, which is previous quarter what it was and what is current quarter, and previous quarter what it was in the current quarter. So I think sequentially the pulses now number is about 20% up, and spices is about 250% up as per the data I have.
Okay, thanks.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you all for the session and the questions. I think as we move forward in our strategy and as we move forward in our quarterly disclosures, I think more light will emerge on the segmental reporting. I do understand a lot of queries on the segmental reporting being the first quarter which we have reported, and we remain focused on our strategy in terms of delivering good cash delivery in terms of basic chemistry products and focusing on the growth of consumer specialty. Thank you all. Bye.